And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. Of course, it's Monday. It's also the beginning of December. It's the last month of the year. This year's gone by very quickly. If you haven't done your Christmas shopping yet, you have about 22 days. So get it together. Get it together, people. We need you to go out and shop. Consumer spending, very important this time of year to support the economy. So please do your part. It's like back during World War II, right? Do your part. They issued war bonds, roll up your sleeves, buy the war bonds. Right. So the same thing for Christmas this year. Christmas bonds, yes. So a few things to get into this morning as we do start to talk about the wrap up of this year. So on Friday, not surprisingly either, I had said last week that the week of Thanksgiving, which is holiday short because of Thanksgiving, tends to be a little bit better in terms of performance in Major running the asylum. And it was a little bit sloppy. We had a little bit of, back and forth in the market, but by Friday, the market ended at new all-time highs and is still tracking the best performance of any year for the S&P since 1998. So pretty incredible. It's been a very strong market year. We're up about 26% for the year so far. So it's been it's been an easy market. Basically, if you just have money invested for the most part, you've done fine. Interestingly enough, not all stocks have risen. There's quite a few handful of stocks out there that have really underperformed this year. Enphase Technologies is a good example. Walgreens Boots has drastically underperformed. I think it's actually the worst performer for 2024. So there's certainly laggards to the markets, but overall, stocks have done very well. The more speculative stocks have done the best so far this year. They've done very well. And again, that's not surprising. Speculative assets and assets that basically track investor optimism and speculation, like Bitcoin is a good example, has done extremely well this year. And there's a very high correlation historically between risk taking and cryptocurrencies. So when risk is on in the market as it is this year, not surprising that cryptocurrencies are doing exceptionally well this year also. So again, but this has been a good year overall, and it looks like we're going to try to wrap that up. Now, a couple of things. Markets are technically very overbought right now. We'll talk about this in a few minutes when we do our our before the bell segment. But technically, markets are very overbought right now. And again, this is not surprising given the breakout to new all-time highs, the action last week. This is the setup for a bit of sloppiness over the next 2 weeks or so. And that is going to be because we're about to get some mutual fund, a lot of mutual funds have to distribute their capital gains. We talked about this last week. That's going to start really at the end of this week, beginning on Monday of next week. That'll go for about 2 weeks. And so I would expect a little bit of sloppiness over the next few weeks heading into Christmas. Now, once we get through the Christmas holiday, then you have the window dressing for the end of the year. That's your traditional Santa Claus rally. The last 5 days of the year, first 5 days of the new year, that's the Santa Claus rally itself. And so that 10-day period tends to be very strong for stocks, and no reason not to expect that to occur this year. So where we in this market, don't know. Probably not a lot higher than we are right now. Probably get a lot of back and forth. But again, we're a little bit over 6,000 now on the S&P, 6,100 by the end of the year with the Santa Claus rally, not out of the question. But we may, pull back a bit here over the next couple of weeks and then rally right back to where we are, for the end of the year. So again, we might be right where we are, a little bit higher by the end of the year. I wouldn't expect dramatically higher from here. Because again, we've already had an exceptionally strong year, but certainly it's not out of the possibility that markets could be higher by year end, simply because this also December tends to be historically on a percentage win basis. December is one of the months of the year that has the highest win rate for stocks historically. Doesn't mean it always wins, and this year could certainly be that case, but we'll see. We'll see what happens. But again, there's nothing really to be overly concerned about. Economic data continues to come in good. Consumer spending was a little bit weak in October, but not dramatically weak. Over the next few days, so Friday was Black Friday. Today is Amazon Day. So Cyber Monday is today. So over the rest of this week, we're going to start getting some numbers from Adobe and the Retail Sales Federation, the Retail Federation, et cetera. Kind of talking about what early kind of Christmas shopping looks like. If those numbers are good, that should bode well for the rest of the month. If not, if those numbers come in a lot weaker than expected or disappointing, we may run into a little bit of trouble over concerns about the consumer. We'll see. But there's certainly some issues with the consumer, and we've certainly seen some of that data as of late. And again, we just saw consumer spending numbers for October, and they were okay, but they were weaker than expected. But that brings us up to, kind of where we are. So let's talk a little bit about what you need to know before the bell this morning. So again, market's doing just fine. And as we can kind of continue to talk about, the market just kind of continues to grind higher here. And again, we've talked about this. We're back onto a buy signal, and the market is trading well above its kind of its 50 moving averages, et cetera. So again, expect a pullback here over the next couple of weeks, as I was saying a moment ago, because of mutual fund distributions, et cetera. And, in this chart, as again, we kind of look at, the market is overbought on a relative strength basis. So typically when we get overbought, you're going to get some type of correction here again. So I would expect that. But again, the deviations from longer term running moving averages, et cetera, continues to be, a bit of gravity that will likely kind of pull the market back a bit. We're seeing the same kind of setup in markets, kind of really across the board. The NASDAQ is also doing very well. It's not performing as well as the S&P right now, but I would expect it to kind of play catch up here towards the end of the year. Interestingly enough, relative the S&P 500 equal weighted index is also very overbought. It's been playing catch up here. Again, as the market rallied this year, we began to kind of broaden out, really kind of after August, and the relative performance of the S&P 500 equal weight has rallied along with it. But it too is getting decently overbought here and extended from means. So again, we may see a bit of a broader kind of consolidation or pullback here over the next couple of weeks, just to work off some of that. It won't take a lot to work off some of that kind of overbought condition that we're seeing, but I would expect that to kind of be the case again, just because we are so deviated from longer term means currently. So again, just, this is, as we kind of talk about, this is, this rally on Friday was good, pushes new all-time highs. That's great. This is where, kind of look at your positions in your portfolio. Just think about, hey, should I take some profits here? Can I rebalance some risk over here? Things that aren't performing with the market, this is a good time. Don't forget, this is a good time for tax loss selling. So if you own laggards to the market this year, or you have losses in your portfolio, this is a really good time to clean those up. Just sell them and have those capital losses off, so you can offset some gains in your portfolio. And then again, you remember, you can also carry forward $3,000 worth of losses against your personal income tax, next year as well. So again, there's some reasons to do some tax loss selling here, but more importantly, get rid of the anchors in your portfolio so that your portfolio can perform better. And that just allows your performance to kind of track closer to where it should be. We typically get anchored to losers, hoping they're going to come back, but sometimes, and this is a great time of the year to do it, it's time just to say, goodbye and let them go. So, all right, when we come back from the break, we got some stuff to get into this morning. That's what you need to know before the bell this morning. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
And good morning. Welcome back to the show. Of course, it's Monday. It's December. A lot of things are going to be happening this month. First of all, more importantly, we are about to open up registration for the upcoming economic summit that will be on Saturday, January the 18th. Myself, Michael Leibowitz, Richard Russo, Danny Ratliff, Adam Taggart will all be here to talk about markets, the economy, the outlook for next year, all those type of things. So that'll be on Saturday. So mark this on your calendar. Saturday, January the 18th. We'll have that economic summits live here in Houston at the Royal Sonesta Hotel. So come on in. We'd love to have you. We'll open up registration on the website here probably next week. So again, we'll have an early bird special. It's $99 for early bird tickets. That will go up to $149 after January the 1st. So that's coming up here very shortly. We'll get that registration up and running. Seating is obviously limited because it's at a hotel, so there won't be a lot of seats available. So a couple of things. Lots of sweeping appointments by President Trump right now for his new staff. You know, this is a clear change and a lesson learned from his previous term as president, where he failed to make a lot of appointments when he was going into office, and that really kind of stymied his ability to get policies passed. He's definitely learned his lesson and is making a wide sweeping array of appointments across the board. So this is going to have definite impacts to the financial markets in particular, because some of these appointments are going to be attacking regulatory issues relative to the markets, whether it's healthcare, whether it's the investing market. Chairman Gensler, the SEC chairman, Gary Gensler, is going to be stepping down and resigning prior to Trump's inauguration. So we'll have a new SEC chairman. So regulatory changes afoot are coming down the road, and that's certainly going to have impacts to the overall market, depending on what but again, I don't have any idea what those are going to be, because I don't know what the regulatory changes are and exactly how they're going to impact various things. But one of the big risks going into next year, and again, we've had two very strong up years. We had a 24% return last year. We had a 26 so far. Slap on dividends is going to be closer to 28% right now. If we finish where we are today, it'll be closer to 28% return on a total return basis this year. So we've had two very, very strong years back to back for the markets. And one of the issues of concentration, which we have in the market, right? We've got a very concentrated market. Top 10 stocks make up about 37% of the total S&P 500. So it's a very concentrated index. One of the issues with high levels of concentration is a pickup in volatility. Historically, when you have a market as concentrated as it is currently, you're going to have a pickup in volatility next year, and that should be expected if you are making mass regulatory reforms, kind of across sectors and industries and markets and those type of things. It's going to cause some disruption, and while that's what he wants, that's obviously that's what what President-elect Trump wants to do, is he wants to reform, and that's going to be disruptive when you do that. It's going to potentially lead to a pickup in volatility next year. So one thing that we have to think about as investors as we move into next year is that the current kind of complacency of the market is a risk that we need to be aware of. Asset allocations by professional managers are at all-time highs. In other words, that everybody that's going to buy stocks has pretty much bought them. So as Sam Stallwell once said for S&P, he said, if everybody's bought, who's left to buy, right? And the market, what drives market prices higher is having more buyers than sellers. And right now, nobody wants to sell. So what few buyers you have out there buying additional stocks, that's pushing markets higher. And we have a lot of foreign inflows of capital. We've had a dramatic increase in capital being vested into U.S. markets, and that's why the dollar's been rallying strongly. That can change, right? We still have a Federal Reserve that's doing quantitative tightening, which is extracting liquidity from the markets. But that's being offset by inflows from foreign countries into the U.S. markets. So again, any changes next year, regulatory issues, geopolitical issues, et cetera, that potentially changes that flow of capital into the markets for whatever reason, could potentially set up for a lot more volatility. And I think this is the one thing that we have to really kind of pay attention to. One of the other kind of things that he wants to accomplish next year is reducing government spending, reducing deficit. And as we've talked about before, and I've got an article coming out on this tomorrow. So tomorrow I've talked about this article for a while now. Tomorrow is going to be the article on the Kaliki profit equation, which is basically where corporate profitability comes from, which is at record highs. But a lot of that comes from debt and deficits, government spending. So if you're going to reform that and you're going to reduce debts and deficits, that's going to have an impact on the financial markets because it is a source of liquidity. And it's also a source of employment. It's a source of spending. There was an interesting article out there, or I shouldn't say article, but a graphic out this morning talking about the richest states and the poorest states in the country, in the United States. The richest state in the country on a per capita GDP basis, and I'm going to show you this graphic here in 1 second when I can get it to actually pull up for myself. But the richest state in the United States, and it's not a state, it's Washington, D.C. On a per capita GDP basis, it is the richest, I guess, territory that we have, right? And it's pretty amazing. Of course, it's not surprising since you have Nancy Pelosi, worth $256 million trading in Congress. But this is kind of the issue that we have. And so when you start looking at, there you go, Brent. So here's the actual graphic so you can see it. The poorest state in the United States is Mississippi. And its income on a per capita basis is $51,420 per person in Mississippi. They're the poorest state in the country. They are richer on a per capita basis than the UK, France, Italy, and Japan. So the point is that, we talk a lot about capital. People are upset about capitalism and how unfair it is. The poorest state on a per capita basis, Mississippi, is richer than the UK, France, Italy, and Japan. Only Germany and Canada are slightly richer than the poorest state on a per capita basis than Mississippi. But again, you go back to New York, it's the second richest state, $110,000 per person. Massachusetts is the third richest state at $105,000. The average U.S. state is $81,600 per person on a per capita basis. Again, Washington, D.C., $259,954 per person. Pretty amazing. But that's where all the money is concentrated, right? So just all the lobbies, everything that happens in Washington, just that's why it's such a very rich territory in the United States, because of all the power and concentration that is there. And one of the things that Trump is talking about could change that dynamic, because he's talking about moving agencies out of Washington, D.C. So if I move an agency out of Washington, D.C., say I move it to, say there's an agency I want to get rid of, right? And I can't fire the employees because it's very difficult to fire a government employee. So I just move them to somewhere, I move that agency to like the middle of Wyoming, right? Get a building there, the Department of Government Education, whatever it is, right? Whatever agency you're trying to get rid of, you just move it to Wyoming. Well, it sucks all of that capital out of the United States. Out of Washington, D.C., and it moves it to potentially Wyoming, but nobody's going to move to Wyoming, right? So they all quit. So all of a sudden, you have this reversion of incomes, and this is what I'm talking about. The things that we have to be, kind of mindful of is policy changes as you move forward can have an impact on economics. Corporate profitability comes from economics, and this is part of the cliquey profit equation. So again, all of that government spending is going to lead, and changes to that government spending is going to have an impact on markets next year. So while we've had very comfortable market returns over the last 2 years, there is a higher than normal risk right now because markets are extremely overbought. They're extremely leveraged. You've got a lot of speculation in the markets. In fact, that was this past weekend's newsletter. A tremendous amount of speculation in the markets right now that has potentially been the setup previously for a pickup in volatility. So this is why I've been kind of a little bit more reticent. While I think this year is going to end up well, there's no reason it shouldn't. I'm a little bit more cautious about next year. A lot of market analysts right now, whether it's Morgan Stanley and Goldman Sachs, they're all kind of competing with each other to get a higher number for the end of next year. S&P 7,000, S&P 7,500. I think there's a reasonable possibility. I'm not saying that the markets are going to crash, but I think there's a reasonable possibility that we could be stuck kind of around 5,500 to 6,500 next year in a more volatile range, particularly if these changes that President-elect Trump wants to make are done very rapidly. So we'll see. But again, this is all speculation. I have no idea. That's why we have to navigate this on a daily basis. It's why we look at the markets every day. It's why we look at the stock charts every day and make our investment analysis from that. The rest of this is just guesses. So I'm guessing. And I guess we'll be back after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Did I tell you I got off good this year for Christmas?
How'd you swing that?
She told me what she wants for Christmas. I'm like, I am all in on this.
The Real Investment Show podcast.
A wet dry vac for our back porch.
Wow.
That's what she wants.
That is fantastic.
I know. I was like, yes, I can do this.
Same show, your schedule.
Hey, can I throw in some floor mats too for the car?
Let me tell you, she would be thrilled with that.
That's fantastic.
She is.
At realinvestmentadvice.com.
She's a geek. I love her to death. I'm getting off good this year.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
$85 people affected by THC contaminated pizza. Apparently, these people all bought oil from this one place to make pizza with, and it was THC infused oil, and so they all went to the hospital, experiencing dizziness, nauseousness, and the munchies. But the pizza was rocking. That's all I'm saying. So only in Wisconsin would this happen. There are people that write articles sometimes. You just kind of have to shake your head. Slate, which is not known for its honesty in reporting, to say the least, but also is not known to be writing articles for more intelligent people, wrote a article called "The Thanksgiving Effect," and it is a solution for the housing problem. And I was just absolutely amazed at this. Every holiday, I'm just going to read to you from the article real quick. Every holiday has its lesson for the study of the city. Halloween illustrates the quality of our neighborhoods. True statement. The 4th of July spotlights our public gathering practices, and Thanksgiving is the moment to contemplate the mismatch between the housing stock and the people who live in it. According to census analysis from last year's apartment list, there are an astonishing 137 million spare bedrooms in the United States. This is the solution to the housing problem, is spare bedrooms. Here's their conclusion, basically, is that people are moving out of the cities, the big cities, Boston, Chicago, New York, because of why, right? So just think about the why for a moment, why people are leaving these big cities in particular and moving elsewhere. So this is leaving a lot of houses in these cities with extra bedrooms in them. And so the conclusion is, so consider this, in 1970, the share of U.S. households with 3 or more people and the share of U.S. households with 3 or more bedrooms was about the same. Today, 2/3 of houses have 3 or more bedrooms, just 38% of households have 3 or more people. So part of this is demographic trends, is people are having children later, they're not having children at all. And in fact, if you look at the millennials and Gen Zers that are coming up, they are either A, not wanting to have children at all, or they are having fewer children and they're waiting much longer in life to have children. And there's a variety of reasons for that: careers, money, obviously, finances, etc. But also just it has been a shift in the perception of what people want out of life. In other words, back in the 60s and the 70s and really even the 80s, getting married, having kids, having a family, that was a kind of a motivational driver for women, but also just people in general. The idea was to, go to college, get graduated, get a job, graduate high school, get a job, get married, raise a family. That was what you did. Today, it's more of the me generation, right? It's all about me, what I want to do, the things I want to have. And so having kids and a marriage, those type of things slows that pace down, right? I can't travel and do entertainments and those type of things as easily if I have small children to take care of, right? I mean, you know what it takes to raise a kid. So people are choosing to have less children. So it's a societal thing as well as it is a financial thing. And that's okay. I'm not saying there's anything wrong with that, but demographics are very important to the survivability of the economy over time. One of the reasons, as we were talking about earlier, that Japan has a per capita GDP of, basically lower than Mississippi and is probably one of the poorest, countries in the world at $33,000. They have no birth rate. Their demographics are completely inverted. You have a very, very old demographic that's dependent on the social welfare. Younger people can't get a job. So they are not having kids. They have a huge demographic problem. And your demographic trends dictate your economic prosperity. And while that has not caught up with us yet is a key word, the demographic trends in the United States is following the footsteps of Japan. And the end result of this is not good for younger people. But again, something that us boomers won't have to deal with because we'll be dead soon, thankfully for them, and that'll free up some extra bedrooms. But this is the conclusion of this. This is one of the greatest paragraphs in this whole article. Unlike the nation's millions of vacant houses, that's right, we have millions of vacant houses in the United States. Where are these vacant houses? Well, the article tells us. They tend to be in places that people do not want to live. These spare bedrooms are often but there's spare bedrooms in places that people would like to live, right? They don't want to live in the big cities where they're crime-ridden, can't get a job, those type of things, right? But in places you want to live, there's these people that have spare bedrooms. Once they might have been rented out to boarders, but we don't do that anymore. But that model has unfortunately fallen out of fashion in spite of platforms like Airbnb, etc. And perhaps the owners don't need the money. No, I just really don't want people living in my house. Especially today. Today, adult children cycle in and out, but few young married couples want to cohabitate with mom and dad. Intergenerational living might be more popular than it was before, but if the shoe were on the other foot, if bigger houses were more evenly distributed, maybe that wouldn't be the case. This is their thesis, right? So we should evenly distribute these larger houses. Here's the great line around it. Locked-in mortgage rates and property tax abatements weren't enough to keep aging households in place. The prevalence of single-family zoning issues that neighborhoods have no building stock besides large standalone houses give the owners of these homes a place to downsize, and you might put some of the 137 million spare bedrooms to use. So the solution to the housing problem is to get boomers and Gen Xers to sell their house and to downsize. Great. Who are you going to sell the house to? All right, I'll sell you my house. I've got 2 extra bedrooms in my house. Not this weekend because all the kids were home, right? It was Thanksgiving. But I have 2 extra bedrooms in our house. You want to buy my house? Fine, I'll sell it to you. Give me the right price, I'll sell you my house. No problem with that. I'll go buy another house. It's not a problem. Problem is can't afford it. They haven't been in the workforce long enough to save up the money to buy a house. And see, part of the housing problem, and this is the thing that nobody wants to discuss. The housing problem that we have is driven by 2 factors. One, people want houses that they can't afford, right? Because they see the houses on social media and on the flipper fixer houser upper shows on television. You know, it's like, oh, I want my house to look like that. You know, it's like these shows where they're out in California and they're going to look at these houses, and it's like, okay, you know, here's Jimmy and Bob. She's a stay-at-home mom, and he paints pots for a living, and they're looking to buy $1 million house. In what world does that work? Well, it works if you can leverage your way into the house by having no money down loans, having 3% mortgage loans, those type of things. But the consequence of that is elevated houses, right? Your house prices are driven by supply and demand. That's it. If I increase demand by lowering the ability to buy the house, right? So by lowering the standards, right? So instead of having a 20% down payment like we had back in the 80s and the 90s, you can now get into a house for 3% down or no money down, whatever it is. Well, that increases demand, right? More people can afford a 3% down payment than they can afford a 20% down payment. Increases demand. So prices go up of homes. This is why we didn't have a housing shortage back in the 80s and the 90s, because you had to have a 20% down payment. There was no split mortgages. There was none of these other funny money adjustable rate mortgages. It was a 30-year mortgage. That's what you had. And you didn't have a housing shortage. Supply and demand was balanced by the people that could buy the house. Prices were relatively reasonable because, again, supply and demand was well balanced. If I built a house, I couldn't charge a lot more for it because there wasn't the demand for it. Now I can buy a house and I can build a house or put a house up for sale and it's sold tomorrow because people can afford it. They can get access to the loans. The banks will lend them the money. FHA will loan you money at 3% down. So I don't need to save up a lot. But see, we don't want to admit to the factors that are driving the housing boom, which was a function of lobbying efforts by the home builders and the realtors to get more people into houses. And now you create this problem. Now you want to complain about it and say, okay, well, the thing we have to do to fix this is to kick old people out of their houses, move them all into retirement communities so that young people can buy their houses from them. They can't afford the houses. Okay, I'll stop ranting. Stupid articles really fire me up. Let's address the problem. Then we can talk about the solution. All right, quick break. We'll be right back. Wrap up the show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
If you're watching our YouTube channel today, hit those like buttons for me. Certainly appreciate it very much. As I said earlier in the show, I'm going to kind of start reminding you here. We're going to have registration set up probably next week for the upcoming Economic Summit, January the 18th, right around the corner. $99 early bird special. It's a live in-person event, and we will have all the details for you on the website here soon. But we're going to kind of be reminding here, get you set up for that, and then ticket prices will go up to $149 after New Year's. Couple other things, just kind of wrap up. We kind of talked about the issue for the market this year going forward, and again, expect more volatility. It's hard to, and again, it's not impossible, right? As we said earlier, it's not impossible for the market to crank out another 15, 20% up here next year, right? It's happened before. There's only been 6 times in history where the market cranked out above 20% rates of return 2 years in a row. Two of those periods were decently negative in the third year. The other 4 years were positive on average about 12%. So it was a lower return year than the previous 2 years, if not negative. And again, if everything remains status quo right now, and if everything remains exactly the same as it is now, economic data remains the same, just kind of keep ginning things out, having it up here next year won't be surprising. There's a lot of risk to that outlook, especially on the earnings side, because of potential changes that are coming to government spending, deficits, those type of things. And that's if they occur, right? This is, as we were saying earlier, President-elect Trump has a lot of plans for doing things. Certainly certainly nominating the people. A lot of these people have to be appointed, right? So they have to go through the Senate confirmation process. And there's a risk, and as we saw with Matt Gaetz, there's certainly a risk that some of these nominations may not survive the confirmation process. So again, there's a few people that don't, have to go through that process. The chief of staff, as an example, doesn't have to go through that process. But some of the heads of these agencies do. And they may or may not get appointed. There are still a lot of people on both sides of the aisles, Republicans and Democrats, that do not like Trump. And they are going to oppose him in any way possible. And one way to oppose him is not to confirm his appointments. So again, lots of plans that we need to be aware of. Whether or not they come to fruition will be a different story. But we need to pay attention to this because, again, that's going to have an impact on corporate profitability, corporate earnings. Markets are a function of corporate earnings. So as long as earnings estimates are on the rise and corporate earnings are coming in line sort of with estimates, markets are going to increase. Because as investors, we invest based on expectation of earnings catching up with current valuations. Yes, a lot of concern about valuations. In the short term, valuations are simply a function of psychology. And right now, as shown in the recent consumer confidence report, which was in this past weekend's newsletter, consumers are more optimistic about higher stock prices in the next 12 months than ever on record. Which leaves us at risk of disappointment, right? Because everybody's super optimistic. That leaves you open to disappointment. That goes with all of these things, right? It's interesting because we have a lot of people chasing very, very speculative assets on a variety of different bases with the assumption that this time is different. Bitcoin's a good example. MicroStrategy is a great example of that. And all you have to do is go back to 2021, late 2020, early 2021. Everybody's very excited about Bitcoin. MicroStrategy is going up, and then you get into 2022, and you lose a big chunk of your money. That's the way markets work, right? Theses are great. I think that, Bitcoin is going to replace the dollar, right? It never will, but just go with that thesis for a moment. Bitcoin fixes inequality. Go with it, whatever. Okay, it's fine. Doesn't mean prices don't go up and down. And when prices get too extended in one direction, you're going to have a correction of magnitude. Because that's what happens in speculative booms. And right now, we're in a very clearly speculative boom in the market. And you can have all the fundamental support that you want for something, doesn't mean that prices can't get well outside the fundamental trends. And when you lever that bet, like with MicroStrategies, causes the corrections to be bigger. The rises are bigger and the falls are bigger. And that's just the way markets work over time. And so it's fine, to take speculative bets, and I encourage you to do so. Just control your risk. Just make sure that your speculative risk that you're taking, that you are also monitoring that risk and taking profits. As long as you sell some along the way, it's great. Speculation is fantastic. This is why, if you look at professional gamblers, there's very few professional gamblers in Vegas that can make a living gambling. But they are very disciplined at their craft. They know when to bet, they know how to bet, they know when to take money and walk away. Most people that go to Vegas lose money because they don't understand the odds. They don't understand how to calculate risk. They don't understand how to manage their bet size relative to the risk that they're taking. So they wind up losing money more often than not. But there's a few people that can win on a consistent basis. They still lose from time to time, right? But they win enough to make a living at it. Same thing with the stock market. If you think you've got the tiger by the tail, you don't, right? And the thing that separates really good long-term investors from everybody else, the guys who survive the long-term game and build wealth, they're relatively very few. Because the vast majority of individuals wind up chasing an item, thinking that this time is different, And it's not. MicroStrategy is a good example of this. They're using convertible debt. I saw an article about this the other day. Using convertible debt to buy Bitcoin. Shouldn't be any problem with that. Do you understand how convertible debt works? Convertible debt says that as long as the price stays above a certain level, everything's fine. If the price of whatever it is, so let's say that ExxonMobil issues convertible debt. There's a strike price to that debt. As long as the price of the stock remains above $100 a share, right, you own the debt. But if the price falls below $100 a share, the debt converts into equity, which is a dilution to everybody else that actually owns equity in the company. But more importantly, do I want to own ExxonMobil if the price is collapsing below $100 a share? Do I really want to get converted into equity? Probably not, because I've suffered a very massive loss in my capital already, and now I'm just getting converted from the debt into equity. And that's the problem with convertible debt for a company like MicroStrategy. As long as it remains above that strike, they're fine. As long as Bitcoin doesn't collapse at any point, like it did a couple of years ago, they're fine. But if it collapses below that strike, all of a sudden, they got problems. And it depends on what it converts into. Does it convert into company stock or does it convert into Bitcoin? Right? So you have to really understand what you're getting yourself into. Levered bets are fine. And this was the article. That's the article I was reading talking about this. Like, as long as the price keeps going up, MicroStrategy's great. They can issue debt. They can buy Bitcoin. And since they own about 4 or 5% of all the Bitcoin outstanding, they're basically one of the sole buyers of that, because if everybody's holding Bitcoin, who's buying it, right? Somebody's got to sell in order to buy. So as long as price goes up, this was the thesis of the analysis, as long as the price of Bitcoin goes up, they can issue debt to buy Bitcoin. He never explained the problem with what happens when the price goes down, and it eventually will. But that's the way markets work. And whether it's meme stocks, whether it's Bitcoin, whether it's tech stocks, whether it's penny stocks, it doesn't matter, right? All assets are going up right now. Everybody's exceptionally bullish. Everybody's exceptionally optimistic. Just understand that something will happen. Could be a year from now, could be 2 years from now, could be next month, could be March. Nobody knows. But something will happen that will cause a reversion in the speculation. That's why you manage risk. And that's why we just consistently talk about here managing risk. I don't care what asset you own. I own Bitcoin, right? But I know how to manage risk. I know when to sell. I know when to buy. I know how to manage that risk exposure over time. I've been doing this for 40 years. The question you have to ask yourself is, can you do that? And if you're not managing risk, should you be? The answer to that question is yes, but you have to figure that out for yourself. All right, that wraps up the show for the day. Be back tomorrow with John Penn. Be sure to go by the website. Our daily market commentary is out tomorrow. I'll have the article out on the Kaliki profit equation. We'll talk about that in detail tomorrow here on the show. And in the meantime, get by the website. Let us know how we help you. RealInvestmentAdvice.com.